Hello, this is Alex with Mainstream Investing, and today I would like to discuss approaches to investing. You often hear people say that they are a value investor or a growth investor. These are considered two main approaches to investing. But what does it mean? It refers to what companies you invest in. A growth company is expected to grow at a higher pace than market average. On top of that, if they have positive net income, they will be reinvesting into themselves to accelerate growth. Some may have increasing losses in hopes of business expansion, but most of the companies won't be paying you any dividends, and their stock price may seem expensive. If a company is expected to grow at a higher pace, investors are willing to pay more for it. That's why the share price may seem expensive. But if the company does not live up to the high growth expectations, the stock may suffer sharp declines. Growth stocks are considered a riskier investment since there is no guarantees that a company can continue growing at a high pace or that they will become the next trillion-dollar company. One way that you can benefit from investing into stocks like these is from your shares appreciating, since companies that are high-paced growers usually don't pay any dividends, like I mentioned before. On to value investing. Value stocks are usually shares in a well-established and large companies that are trading below what they are actually worth. But nowadays, you can say that a mature company with strong and predictable earnings can be called a value company. These companies grow slowly, but they are bringing in a lot of revenues. Since they are so well established, they don't need the cash that a growth company would need, and they will be paying out a dividend. You may ask, which approach yields better returns? There are pros and cons to both of the approaches. It is worth mentioning, though, that over a short period of time, performance will largely depend on point in the cycle that the markets are in. Growth stocks tend to perform better in low interest environment since debt is cheap and growth companies need that cash to keep growing and accelerating their business expansion. Also, if the markets are in a bull cycle, growth companies do very well. Value stocks tend to outperform during recessions, market downturns, and early stages of a recovery. In my opinion, diversification is the best way to benefit from both of the approaches. Thanks for watching. Like and subscribe, and hope to see you again.